How's it going, everybody? Welcome back to another episode of Smart Money, Smarter Moves, which we just launched this past Tuesday, giving you the background on who Kyle is, who I am, and what the podcast behind Freedom Family Office is. For those who haven't heard it before, the idea behind this podcast is to come with fresh ideas, a rapid educational session in your pocket with under 10 minutes. So the same amount of time it takes our busy clients to go grab a coffee is how long we want this to be. And every single week I'll be interviewing our CIO, Kyle Cain, who manages money for our ultra high net worth clients, and excited to be able to get gems from him each week. So today there's a couple things we're going to talk about. We're going to focus predominantly on Q2 earnings, but even before we jump into that, Kyle, one thing that keeps coming up, especially the last few weeks, you hear it with President Trump, is this idea of Powell. I just saw 4 days ago, he posted a tweet about, hey, I'm not telling him to resign, but it would be good if he resigned. And so, when you're watching this, Powell controls interest rates. How are you thinking of that, and how are you navigating that with clients, with Powell at potentially could be out of here soon? Maybe he's not, but who knows?
Yeah, I mean, so it obviously is a pretty big dynamic and has some broad implications, right? Like we always had a independent Fed, and to try to think that it gets politicized in any way can certainly have some, bigger impacts on our funding market. So you'll kind of see the 10-year treasury, 30-year treasury has been moving based on some of the commentary coming from Trump. And then, there's concerns on obviously him firing Powell. What could that be? I think first I'll just say I doubt that anything happens. Right now he's on the leg that there's going to be some sort of fraud with the renovations of their, the Fed, building. That likely they're not going to determine if there's any fraud there, but it's still more rhetoric to kind of push his hand. I think the bigger thing of bringing that up is Jerome Powell's term ends May of next year. And if he wanted, he could stay on the board of governors for another couple of years after that. I think Trump and whoever the new Fed chair, is that Trump appoints would probably want him to resign. So that way Trump has one more seat that he can fill of sort of his own people, which again goes back to, right, do you really want a president's people on something that's supposed to be something not politicized and complete independent? So again, in the end of the day, I'm not too worried. I think it's more rhetoric. I think at the end of the day, it's going to remain independent. But it does have some implications on our overall funding. I think again, we're going to go back to be able to do rate cuts some point later this year, and the longer end of the curve will settle down with this rhetoric.
Right. I think that's a helpful point because, for someone that has such control in terms of interest rates, and you think of our debt, and being able to just tweet about, hey, we're going to get rid of this guy, tomorrow. I hope he gets fired. He might not get fired. And you know how Trump can be with his Truth Social post. So that's a helpful way to look at it. The other part of the episode I wanted to talk about is Q2 earnings are here. And I saw a couple reports this week. We saw Netflix had an earnings beat. They grew 16% in the second quarter. I saw Pepsi had a beat. What are you seeing from Q2 earnings in a rapid insight, and anything alarming, anything positive? What are your thoughts so far?
Yeah, so like you said, we're just out of the gate on it. Coming into this quarter, the overall, estimate was about a 5% earnings growth, which is still a far, which is growth from a year ago, which is a good thing, but it's a far cry from 13% in the last quarter. Some of the thoughts of slowdown, of course, was tariffs, right? Tariffs being a big hit, potentially to their margins, or at least the consumer slowdown in spending going to hurt their margins that way. So far, you know, Q2 earnings season has been good. Mainly it's been a bunch of banks that have came out so far. Like I said, there's a few other consumer products. Netflix beat, a few other ones beat. Banks are always they always kick off earnings season, and they're a really good barometer of what's happening in the economy, right? Because they're the one who's lending and the one who's saying, what are the delinquencies on, some of the credit products. And all the reports out of them have been, very optimistic. They're beating, their trading revenue has been good since it's been such a volatile market. They make money from trading. Their net interest income has been good. M&A has been, actually better start to the year than we've been used to. However, there's certain areas like home lending, which is still struggling with the high interest rates that we're in. But yeah, none of them really came out with any signs that the consumers stretched too much. They all said that they think the consumers staying resilient. We just got a retail sales report, but yesterday that was a lot better than expected. So so far we're not seeing even with the consumer companies, there's only been a handful that have reported so far, tariffs hurting them quite yet. And we're not really seeing that too much in the inflation data that came out last week either, or earlier this week either. Right. I think that is temporary. We're gonna see companies start to pass through um, the tariff impact to the consumer. Right now they're eating it a little bit, but they're not eating too much because they increased their inventory. They bought a whole bunch before tariffs came in. So they're sitting on this inventory now at the lower cost prices that they have to kind of get through that, which is an inflationary. Once they've depleted that and they start to buy more at the higher tariff rates, then we'll start to see it. So really, so again, the tariffs is the negative, but I don't think that's going to hit too much in Q2 earnings. So I think Q2 earnings going to be good. The other big positive that we're probably going to see this quarter in earnings is the falling dollar. The dollar's dropped about 10, 11% since the start of the year. And that helps the big multinational large cap firms the most. Like about 28% of the S&P 500's revenues come from, overseas sales. And if you kind of focus that even more to the mega cap,
Right.
companies, the tech sector is about like 56% of their revenues come from overseas. So a 10% drop in the dollar is actually a big ballast and a big, benefit for their earnings. Smaller cap companies and things like that doesn't quite potentially help as much. But at the end of the day, I think it's going to be a little bit more of what we've seen. We're going to beat the 5% earnings growth. If we kind of beat it like we historically have, we could see 9, 10% earnings growth by the end of this quarter when we're all said and done. And most of that, like I said, is kind of like what we've seen in the past. The Mag 7 is going to lead. It's estimated their earnings are going to be up 14, 15% this quarter versus the rest of the 493. They're going to be up, but more like 3 to 4%, probably closer to 3% at the end of the quarter. So, again, it's still a good quarter. I think that should help keep equities, optimistic unless we get some seriously more negative tariff rhetoric coming in the near future. I think earnings season will be good to be able to, we're sitting at all-time highs in the markets. I mean, again, it's getting a little frothy at 22, coming up on 23 times forward earnings. But I think again, at the end of the day, this is going to be a good earnings season to help support the narrative for right now.
I think your point there, even about, all-time highs, we're having good numbers. It is getting a little frothy. Would you say that we could see that a little bit in Netflix? Because Netflix has this $18 billion buyback, super strong Q2 earnings. The stock is down around 5% today. And I think part of that, what analysts are saying, is elevated expectations. And that's what it's slipping on. But in some way, I'm looking at the report and I'm saying, in a lot of ways, they beat everything. But it's kind of, is there a correlation with those elevated expectations that could potentially correlate to the broader market?
Yeah, I mean, so Netflix is perfect story, right? Like it was a great quarter for them, but they've ran up so much. I mean, now they're bigger than what? They're bigger than like Disney and I think like Warner Brothers combined, as far as
Oh,
their market cap. So it's like investors have realized, hey, it's the future. They're earning, they're producing enough value to warrant what their PE ratio is, but it's pretty much priced for huge growth, so that even if you get good news, sometimes it's not as good as they can't always beat as these crazy high multiples every single quarter. So yeah, that's basically it. So that's where the same thing like Nvidia's ran up here huge now that again, a lot of the deep seek issues are behind us now that they're now able to sell those chips, the H200s, to China, which they were saying was going to be a huge like $8 billion a quarter hit on them. Now that's a huge game changer, but they've just run up like 20% in a few days from that. I still think their valuation is reasonable based on the future growth, but who knows? This quarter They're probably going to show another huge earnings beat and huge growth. But could it be enough, right? If it's already ran up so much, it could be another, hey, they beat, but it's just, the market, the stock drops anyways. So
Yeah. Yeah. No, that's helpful example. I think I wanted to bring up that correlation to show that. So I appreciate that. That is our episode for Smart Money, Smarter Moves. For those listening, if you like what Kyle's saying, Kyle does do free portfolio reviews on behalf of our family office at Freedom Family Office. So if you have a portfolio between 1 million, 10 million, or even more, Kyle is happy to look at that portfolio and compare it to see what he thinks you could be doing better if you're optimized, and especially from like a tax efficiency perspective. So you can reach out to us via our emails or at freedomfamilyoffice.com, and we'll be back next week to give you guys rapid insights. So the same way it takes you to get a cup of coffee is how fast we'll get insights from our CIO, who provides a lot of great gems, Kyle Cain. So we'll see you guys next week. Thanks, Kyle.
thank you.